What is management accounting?
According to Langfield Smith, management accounting is defined as processes and techniques that are focused on the effective and efficient use of organizational resources in which, to support managers in their task of enhancing both customer value and shareholder value.
Now, to have a better understanding of the changes in management accounting practices, the International Federation of Accountants or IFAC 1998 provides framework explaining the development of management accounting. Based on IFAC model, there are 4 stages of the evolution of management accounting practices which will be further explained. The first stage of the evolution started back in the 1950s. The main concern in this stage is cost determination. During that time, companies focused on the determination of cost because it could enhance the financial control of production processes. There were a few techniques used for cost determination, which are the first in first out, FIFO, and the last in first out, LIFO, methods.
Now, move to the second stage of the evolution, which started from 1965 to 1985. During this stage, the focus of the companies have changed from cost determination to information gathering towards effective management control and planning. By gathering valuable information, this can help the managers to utilize those information in order for them to achieve mutual agreement in making the best decisions for their company's financial growth. The third stage of the evolution then took place in 1985, which are focused on the reduction of resource waste in business process. During this period, there is an increase on the global competition due to the advancement of technology development, where this had affected many industrial sectors. As being mentioned earlier, the aim was basically to reduce waste when processing the products, and human workforce can be substituted with new machineries that are more efficient and effective.
The last stage started from the year of 1995 onwards, where the management accounting has emphasized on the enhancement of creation of value. This is the stage where most companies need to ensure that the quality of the product that they are offering are meeting the demands of the customers, or even better than what the customers are expecting. Some of the techniques used during that time are benchmarking, total quality management, TQM, and re-engineering. In conclusion, management accounting practices have evolved over the years, and the practices are still relevant for the needs of the companies, as it can help the company to improve the performance of the company.
5 factors that contribute to the evolution of strategic management practices. The factors are: 1. Organizational size. 2. Competitive strategy. Customer demand. Increased reliance. Advance in technology. Organizational size can be vary into merger. Mergers depends on the economic function, for the purpose of the business transaction and relationship between the merging companies. Most mergers unite 2 existing companies into one newly named company, and some are done through acquisitions, are commonly done to expand a company's reach, expand into new segments, or gain market share. All of these are done to please shareholders and create value in the future. Rules and regulations. Some comes from rules and regulation from the firm itself that will affect it and firm's learning strategy and ability to adapt to changes in the external environment. Theorists said by Huey, 2001, the revolutionary change have advocated that all organizational elements such as strategy, structures, people, systems, and culture have to be changed simultaneously to achieve maximum organizational alignment and effectiveness. Management. Management should take steps to involved by respond to the changes by reorganizing their work processes through adopting organizational design and strategy that have stronger customer orientation. A firm may change their management style, leadership and the overall goals to ensure the changes will benefits the organization. Competitive strategy may be in term of understanding own firm industry. The firm should understand their firm's industry, now and in the future, is a core discipline in strategy formation which every industry may differ from each other. Equally significant differences arise in other countries but may be same in term of the overall framework, but it is depend on the firm to make it unique. To understand industry competition and profitability, however, it must look beyond their differences and view industries at a deeper level to ensure the sustainability in the current market. And also an industry change where this industry change is normally major in type of employment, such as from public practice to industry, or either major changes in job responsibilities that require significant development of new skills. The firm will learn about differences in the industry and assuming increased in responsibilities, by moving to a new department that is significantly different may count towards the market performance that exist in the future, since today the changes was growth rapidly faster than what we are think. Customer demand are include real disposable income. Real disposable income is the amount of money that households have available for spending and saving after income taxes have been accounted for, and are often monitored as one of the many key economic indicators used to gauge the overall state of the economy. Once the income is not meet the need in the average current market, this will create the difficulties that will have to be dealt with, significantly reduce profit potential, and the firm can simply decide not to engage in any activity in that market. Expectations and sentiments. Expectations and sentiment from customers are always will give an impact to the management accounting, just like a just-in-time inventory management system seeks to control inventory costs by ordering only what a specific job requires, or either decreasing holding costs and the amount of money tied up in inventory. This technique works best when customers' demand remains relatively constant and suppliers are in closely maintain the production to ensure income to the business. Some customer may expected that whatever they get will be as expectation and the availability of the products, therefore adopting the economic order technique seeks to manage costs by placing larger orders less often, by setting specific reorder points and warehousing excess inventory. Indirectly, this will allows for intangible costs, such as customer dissatisfaction, and provides for fluctuating demand. Market interest rate. Market interest rate have a big impact to the firm industry. Once many organizations made consideration to investments in advanced manufacturing technology such as computer integrated manufacturing and just-in-time systems, which this coincidence can increase quality, productivity and flexibility as well as reduce cost.
Rapid advances in technology, resulting in new business models.
The development of electronic business communication technologies gives an advantage to customers' purchase products and services. Customers have the ability to acquire information from the internet in order to know wide ranges products offered in the market. E-business, e-commerce, or internet commerce is a new way of doing business through online sales facilities such as ticketless airline bookings and internet banking. It provides a competitive advantage compared to their competitors. Enterprise Resource Planning Systems, ERPS, is an application which has high impact to the business information system. It is a set of integrated software applications which control information and business function. ERP helps in bookkeeping, product profitability analysis and budgeting, fully integrated in database and real-time information. The advantages of ERP is fastening information, searching and processing information which the users can extract the data from the system itself. By implementing new advanced technology in the business operation, it improves customer value and satisfaction. Lastly, increased on strategic alliances. Business needs to acquire new technology sharing from partner in order to innovate their products and services. The changes in business environment demand corporation to compete aggressively in order to sustain for the long period. Strategic alliance is a way of searching product differentiation and competitive advantage. Competitive advantage defined as the advantages that a business may have over another which difficult to imitate, while product differentiation described as a business strategy whereby a firm derives competitive advantage from offering goods and services that have characteristics different from those offered by competitors. A strategic alliance involves at least two firms that remain legally independent after the alliance is formed, share benefits and managerial control over the performance of assigned tasks, and make continuing contributions in one or more strategic areas such as technology and products. By having strategic alliance, business can expand their market development and sharing their expertise in order to improve their business performance.
The relevance lost concept on strategic management, accounting practices. Relevance lost concept on strategic management accounting practices is about how the management lost their important values towards the rapid change in technologies, management style and economy. These changes has affected the management accounting system in becoming less useful to their users. These are one of the reasons why relevance lost concept occurs. First, it's because traditional management accounting practices use past data that no longer support modern-day practices. It is a must to provide a timely and accurate data. For a better planning, evaluate performance, monitor cost and improve production activities. An accurate and timely data is important to help managers in the long run in preparing a complete management accounting report. Secondly, most old manufacturing techniques are not suitable for current business production process and requirements. The uses of old technique using old machines and electronic devices will definitely slow down collecting or organizing in a production process. This is why the introduction of an advanced machine will be able to cater and fulfill many company production requirements. Thirdly, traditional management accounting depends on data provided by the financial accounting. A failure to have a concise and constructive data from financial accounting will limit the decision-making process. Misleading data will bring risk to the company. Thus, strategic management accounting practices were introduced to curb the relevant lost concepts. According to Simmons, strategic management accounting, as MA, are the provision and analysis of management accounting data about a business and its competitors, for use in developing and monitoring strategy of business. Most well known as MA technique are activity-based costing, benchmarking, strategic pricing and many more.